HIMS stock has been getting absolutely destroyed recently. It is down 25% from its all-time high, and if you are looking to buy this dip, I would caution you against it. What I personally would do is come over here and start selling puts. So instead of buying shares outright, maybe you can dollar cost average if you want to. I personally wouldn't. I would just sell puts, because instead of buying the shares just straight up, I would rather get paid each time I would want to buy shares. Buying stocks of publicly traded companies is fantastic, but you know what else is great? Owning your own company. That's where today's sponsor, Limits Express, comes in. They will completely manage an Amazon store just for you, where you can sell products like Colgate's toothpaste, Crest mouthwash, Dove soap. In order to buy these products for a bulk discount for very cheap prices, they have to spend more than $750,000 a month with these suppliers. And that's where you and 150 other clients come in to pool your money and to buy these products at a very cheap rate to sell at a higher rate. The key thing is Limits Express doesn't make any money unless you do. You supply the capital for the inventory, and they do all the heavy lifting, and you get to share the profits together. So I would never take a sponsorship from a business I don't believe in, and Amazon FBA is a completely viable strategy. And the thing is, Limits Express has a team dedicated with experience to help you start your own Amazon store. So if you're interested in starting your own Amazon store and making passive income, use the link below to book a 30-minute Zoom call with their co-founder, Kyle. And you can also check out their website down below. Selling a low delta put would pay you maybe every week if you wanted to. I definitely wouldn't go too far out. I would just stay within the 1 to 2 week range, so you have some room to work with and you can annualize that premium really nicely. So here, let's take a look at this 15-day strike at 21. Pretty low delta at 0.4. So if we do 0.4 divided by 21, that gives us about almost 2% return in 2 weeks. So obviously if you do sell this, you're going to get $40 and you're going to have to put up $2,100. So it really is up to your own personal risk tolerance. I think that it's a pretty good opportunity, especially if you do want to own this stock. HIMS is just a really interesting stock. I mean, all the numbers are really great. It's been performing really well. I mean, in the long run, it's still up. It's still up really nicely in the past year, 2 years. It's just a really volatile stock. It's one of those stocks that you have to have a really strong stomach to buy. You could easily lose 20% in a week on this stock. There's a lot of volatility, so definitely be careful owning this one. But if you believe in it long term, selling puts is one of the best things you can do to own a stock like this. Palantir just doesn't know when to stop. I mean, it's been beaten down, but it just somehow keeps getting bought up. I think there's a lot of institutional pressure right now for it to get bought up. They just got added to the QQQ, and that's going to keep up the buying pressure. And it's such a good performer that towards the end of the year, people are just going to want to get as much gains as they can before the year ends. So this is just one of the best performers of this year. Such a winner overall, and we will see if it does have some pullback, but looking at the chart, it does look really, really overbought. I mean, the RSI is all the way up here. It's been really elevated for quite a long time, but it's just one of those stocks that if you're betting against it, you have to get the timing perfect. It's really hard to time this one because with every downturn, it's just getting bought right back up. So it's really hard to predict what's going to happen. SoFi has been really strong. It's back to the price it was, a few weeks ago. So it's not really that big of a dip, in my opinion. But we will see if it comes back down, touches this long-term support. Right, this $14 is so important to this stock because it used to be such a strong support until it was broken down, because of the macro environment. And after a while, this is where it broke out, and now it's in a new phase of the stock. The sentiment is in a new place that it's never really been in. Back here, this was all, hype, and, everything was going up, and then all of a sudden everything came crashing down, and SoFi was, people didn't want to touch this stock. There was nobody really pushing it until recently. We did see a lot more attention come to this stock, and I'm glad I was able to get shares down here, all throughout here, throughout the bottom, and hopefully we'll see some consolidation, because I don't like to see my stocks go up straight up. I like to see a normal higher high, higher low, because that indicates that there's solid buying pressure, and it's not all about hype, right? Because we're investing in these companies long term, so I want these companies to have a strong foundation and not steal gains away from the future, right? Sometimes the stock price is just going to go way above where the fundamentals are, and it's going to be really hard to produce good future gains with these stocks, especially if you believe in them. Obviously, if you take profits on them, then good for you, right? But I'm not looking to sell, so I like to see higher highs, higher lows, and overall institutions buying in, just good earnings coming out all around for any company, any stock, doesn't matter what sector. It's always the same. You want to see good profitability, and you want to see the story just improving, right? Because the stock market is a future-looking, it's a future-looking tool, right? I don't think there's any better tool to gauge what the future looks like than the stock market. It does seem like the overall market is bouncing off of this, yesterday's really rough day, really rough red day. But if we look back, we're only at, the prices that we were a month ago, a few weeks ago. So it's not anything crazy. We haven't entered a bear market yet. We have yet to see if we bounce up and the uptrend is just continuing to go. I mean, so far, just looking at the chart, the uptrend has not been broken. We are still above the moving averages. There's nothing indicating that we can't go up further. But with every market, there's always corrections, right? Even if we're in a bear market, there's always times that stocks are going to go up, right? There's always going to be green days. And the same thing for bull markets. When everything's green, there are some days that are going to be red. So we just have to be very careful and invest according to your risk tolerance and not overextend yourself. That's what I always say, and that's what I always adhere to. Bitcoin, I don't own really much any Bitcoin, but it's been really strong above 100,000. Obviously, at this point, Bitcoin is really tied to what equities are doing. I haven't seen any real disconnect, long term, within this past few years of Bitcoin outperforming when US stocks are underperforming. They're really close together. So at this point, if Bitcoin does well, then stocks are most likely going to do well as well. It's very interesting how at this point they're really tied with each other. Once stocks are at all-time highs, we always see Bitcoin as well at all-time highs. And when stocks are in a bear market going down, Bitcoin is following suit as well. So we'll really have to see. Even though I don't own any Bitcoin, I'm still really, really happy for the people who do, right? And when Bitcoin does well, stocks do well also. So Celsius did recently have a little fake out, right? We see this happening every now and then. It's very common to see this with falling knives. I mean, just, a little hope and then just right back down. It's a bull trap, right? Getting people to buy in and then goes right back down. So I'm really not surprised because there are certain stocks this year that are just going to continue feeling downside. And recently, I'm pretty sure a lot of investors are really frustrated with Celsius, right? They're claiming that Celsius put out numbers that were misleading, right? Because of their immense growth rate, jacking the stock price all the way up. And then now that, growth has slowed down and Pepsi has, oversupplied their inventory, then they've come down so much that I think they're filing a lawsuit against Celsius, right, as the investors. So that's really interesting to see. really shows that any company can make mistakes, and we'll really have to see how this plays out in court. But yeah, we're still at this basically above $25 line. If we do fall below this $25 line, it seems that $14 to $15, this is around the next really solid support. But I mean, the stock has performed so well. It's next to Nvidia, right, in terms of 5-10 year performance. 10-year performance. But it's still really impressive that even though they dropped from $100 down here, they're still such a large performer because of how much they've gained popularity, all that. They're still 10x from 2020s. So it's just a really interesting stock to keep an eye on. I know some people are really passionate about this stock, like they really don't like it, or some people, they really like it and it's their underdog play, right? But for me, I just want to see where there's opportunity, and I don't have a lot of stock in Celsius, so it's definitely one that I would add if I do see better value towards the downside. But people are tax loss harvesting. A number of companies that have done poorly, they're just going to keep doing poorly, like Transmedics Group. I mean, this year has not been good for these companies. The first half has been really good, right? They skyrocketed all the way up here, but in accordance with tax loss harvesting, most people probably bought on the way up, or on the way down, and they're losing out. They're going to say, okay, well, I'll sell and I'll come back next year, and I'll just take the tax cuts, right? So some people probably bought on the way up, bought on the way down, and they're probably down, so they're going to sell. They're going to say, I'm going to take the tax loss harvesting, and I'm just going to come back next year with this stock, and that's what's going to cause the downward pressure. So really not surprised seeing these two stocks doing really poorly this last few months. So yeah. HITI is my largest holding, and when we see an environment like this where HITI has only 4% institutional investors and it's mostly public investors, it's really, really common to see this kind of pattern, right? We see it drive up and then drive back down. So with every rally, it's just gonna correct itself before it can move forward, because these are people who are taking profits. They know that it's gonna come back down, and they're gonna probably buy back the dip, right? So it's a really solid company. It's still putting out really great numbers. They now have 191 stores. So their long-term target is 300 stores in Canada. And if we do see any push into legalization in Germany, maybe the US as well, this company is going to put their foot in the door and get their business started elsewhere, in Germany or US as well. But in terms of just the Canadian market, they're going to dominate, and they're going to grow really, really nicely. So I was listening to some podcasts on some of these weed stocks previously, and the story is always really poor management, right? Like Canopy Growth, a bunch of those that were the biggest names in weed. It doesn't matter if they were in Canada or the US. If they had bad management, and most of them did, they did not do very well. So they were always diluting their shareholders, and some level of dilution is always to be expected, especially with growing companies, because that's the whole point, right? You're trying to make money from your shareholders to grow your business, and eventually once you've grown enough, you're going to start returning value to your shareholders. But the thing is, those companies, they didn't really care about their shareholders, so none of the stocks really performed well, and they just missed that whole second half of returning to shareholders. So yeah, but with HITI, I always see the CEO Raj, he's always communicating with the shareholders, and he's always really transparent with what they're doing. And he's such a really intelligent businessman. So I have really high hopes for this company, because not only the story, right, but they're putting up really good numbers. So with the new stores that they're putting up, it's not just they're not just diluting shareholders, they're not just taking loans, right? They're using their free cash flow to fund these new stores. So it's organic growth coming from their previous stores, putting their cash to new stores, and they're just growing that way. And that's fantastic, right? We can see this being a really sustainable way to grow and increase revenues, right? Because with these large retailers like this, if you look at a Walmart or anything, they don't have high margins. Maybe they have some items or some sector of their services that has a higher margin, but overall, the largest part of their business has low margins, right? Because they're trying to get more customers with lower prices. So the way that they make a lot of money is with volume, right? With the sheer number of customers they get, it just makes up for, the low prices. So they're able to drive growth because of all the volume that they do. And that's what High Tide is doing, right? It's a classic example of, driving out competition with lower prices, and that's normal, right? In any single kind of business, any kind of sector, there's always competition. You're always competing with smaller companies, larger companies, and you want to have the best prices to gain the most customers. So that's exactly why High Tide is doing so well. They're doing the basics very well, and that's sometimes all you need to do. You need to really focus on those basics and execute at a really high level. So yeah, really, really impressed with High Tide's numbers. Right now, their market cap is under 250 million. So they are a really small company in terms of their market cap, but their growth potential is just fantastic. I can definitely see $5 in the next year, possibly. And if we do see legalization in other countries where they will expand to, $10 is a really easy price target. So, yeah. Rivian is a company that I'm really rooting for. I'm really hoping that they do well, right? I really like their cars. I like seeing their SUV on the road. It's so big, but they're coming out with the R2 and eventually the R3. But with every company that's not profitable, you have to worry about their path to profitability, right? Is Rivian able to hit profitability or just break even with their cars? They are definitely cutting down their costs, and they're definitely doing better in that regard. But it's still really tough, right? And they're competing with Tesla and all of these legacy automakers that are evolving into electric cars, right? But I've definitely seen a lot more confidence and a lot more loyalty to the brand than a lot of other car makers, right? So people who buy Rivians, they really love them, and people who don't have Rivians also really love them. So yeah, most of the time when I see people wanting to buy an EV, I see them kind of going towards Rivian. Obviously, they're still really expensive compared to some Tesla models, most of the Tesla models. But yeah, that doesn't mean that they won't be able to get a lot more market share with their R2, which is a much cheaper vehicle. So we'll just have to see, really, if there's any talk or any numbers that show a clear path to profitability, then Rivian stock is going to do really, really well. That means that this is going to be the bottom. If they don't have a good path to profitability, there's going to be more downside. Unfortunately, there's going to be probably a lot more downside, because a company that's burning cash, no matter how good the story is, it's going to be worrying for investors. It's not going to be good for their business. They need to be, at least showing investors that they're on their way to profitability. So that's just something to keep in mind with Rivian. On the other hand, Google is doing extremely well with Waymo. So Waymo has moved to Miami as well. So they're operating in a few cities now. And I think they're actually moving to Tokyo, which would be the perfect place for Waymo, because I'm pretty sure Waymo doesn't do highway rides. They only do city rides, and Tokyo is such a large metropolitan area that they have a lot more area to work with, and the taxi business in Tokyo is pretty vibrant. People always take them, so yeah, it's such a perfect place for Waymo to go actually. And the thing is, Tesla and Waymo are really different. If Tesla, let's say, if they can get the Cybercab out in the next 1 or 2 years, possibly 2 or 3, right? At a minimum, their car is going to be $30,000. So they said. So it's probably going to be 40,000, but that's so much less than what Waymo is paying for one of their cars. Each Waymo car is about 200,000. So, even if they do shave off 50%, it's still double the price of a Cybercab. And yeah, Tesla has so much data, which is really invaluable in this kind of world, while Waymo is basically kind of just getting started, with all the data, and it doesn't really have the experience, right? It doesn't have all of the data that Tesla has, and Tesla now already has so many cars in all over the world gathering data, so their growth in that aspect is just going to be exponential at this point. So it's going to be really a tight race between Waymo and Tesla. The benefit is Waymo is now actually, on the road with their driverless taxi, so they're ahead in some regard. So yeah, overall Google is a great company to own. I don't know if I would go out and buy a bunch of shares right now, but definitely a good company to have in your portfolio. So anyways, guys, hope you guys learned something. Hope you guys enjoyed the video, and if you want to see more, thumbs up and subscribe, and I'll see you guys next time. Bye.